This is the actual playbook, signals, structure, and strategy for hedge fund grade deals. The ones with asymmetry so sweet that a sharp, smart manager wouldn't just smile, they would double down. And so we are going inside the mind of a capital allocator to break down one real world style deal, piece by piece, that is, why it works, where the alpha hides, and why the smart money would race to underwrite it. Let's dissect why this one deal checks every box for institutional level capital. So, what kind of deal are we looking at? What type of deal are we looking at? Well, this is the deal snapshot. Asset class, private industrial real estate. Location, strategic US logistics corridor, tier 2 city, that is size $42 million total deal. Structure, joint venture, that is 80-20 split with GPLP. Upside strategy, value add through automation, real re-tenanting, energy efficiency upgrades. Downside protection, income-backed lease from AAA rated anchor tenants. Here, the hedge fund smile comes in because of one key fact: asymmetric upside with institutional quality downside protection. So why do hedge funds love this structure? First, cash flow underwrite, not just speculative exit. We are not betting on a miracle here. This has income right from day one. The tenant covers debt service with a 1.7x debt service coverage ratio. Second, mispriced tier 2 market. Large funds often overlook this zip code, which is exactly why yield spreads are still attractive. Third, sharpened IRR via creative repositioning. Solar integration plus warehouse automation unlock new tenant class, which equals a bump in net operating income by 35% over 3 years. Fourth, institutional exit path. Pension funds love stabilized logistics in strategic trade zones. There is a buyer already waiting, just not at today's price. Fifth, GP co-invest. Skin in the game. Nothing attracts hedge funds more than aligned operators. 20% equity check from the sponsor in this deal. The real alpha here isn't just the cash flow. It is in the mispricing of risk plus the certainty of the exit strategy. Now let's look at the numbers. Let's break down the numbers. Input here: purchase price 42 million, debt 28 million at 5.9 interest, 10-year term. Equity 14%. Current NOI 3.5 million. Stabilized NOI year 3 will be 5.1 million. Return profile, that is gross, IRR approximately 19.7%. Net to LPs approximately 16.5%. MOIC 2x over 5 years. Cash on cash 8% to 12% over 5 years. Downside scenario: tenant default will give you 60% LTV, still protected. Hard asset value equals 29 million conservative liquidation. Recovery IRR drops to 7.5%. Worst case equals positive convexity. Even the downside doesn't wreck the fund. And that is why hedge funds sleep with deals like this. But it gets even better when you unpack the hidden call options baked into this structure. First, optionality to recap at year 3. As NOI climbs, LTV falls. Refinancing could return 50 to 70% of investor capital while still owning the upside. Second, ESG enhancement as narrative alpha. Solar installation plus automation equals green story, which equals premium buyers plus lower cap rate, which equals narrative arbitrage. Third, co-invest. Co-invest rights in future phases. Built-in access to next deal equals hedge fund stays in the privilege loop. This creates a pipeline, not just a return. The deal doesn't just produce capital, it produces new deal flow, political goodwill, and long-term leverage. That is what makes a hedge fund smile. Now, to diligence, that is the red flags. Of course, no deal is flawless. Here is what a sharp fund manager would double check before wiring a dollar. First, who is the anchor tenant? Triple A sounds great, but is their lease expiring in 36 months? Second, who controls CapEx timelines? If the GP can drag their feet, your IRR melts fast. Third, what are exit comps really saying? Are they relying on cap rate compressions in a rising rate world? This is where hedge fund DNA kicks in. Control the downside, interrogate the upside. As simple as that. In 2025, hedge funds aren't just hunting for yield, they are hunting for mispriced certainty. Deals like this, well, they don't need perfect conditions. They create their own performance through structure, discipline, date, and data. If you are learning to think like a hedge fund, this deal shows you the blueprint. Cash flow, optionality, skin in the game, and exit clarity. That is the formula. And now you know how to recognize it. As always, subscribe for more.